Welcome to the daily update, where I'll go over the action in the market for Wednesday, March 12th, and we'll see how things look for Thursday, March 13th. Had an up day, not really solid, and we need an awful lot more of what we saw to turn things back more positive. We're still negative in the short and intermediate term. We're a little bit negative in the long term because we're still below the 200-day moving average. We did see an improvement. We saw the mega caps have a pretty good day. We saw growth have a good day compared to value, but we've seen this before. A week ago, we saw a couple of days where it looked like things might be improving, and then everything shifted and went down. CPI came out and it was weaker than expected. It was taken as market friendly. Now, the futures were positive even before the report came out. We gyrated a little bit, and then we got into the cash session and not an awful lot of strength. We didn't see any late day buying, but we didn't see any late day selling either. Most of the gains were more in the middle part of the day. All right, let's go back and talk about what happened, and then we'll look at some charts. We did have a higher open, and we opened right at R1 at 56.29. That was the daily high right there. And then we declined below the daily pivot at 55.79. We actually fell below the unchanged level to go negative, but we found support at a nice round number of 55.50. Then prices rose back above the unchanged level in the daily pivot, so we saw a little bit of a bounce there. And then we just chopped sideways and we closed almost at the 5,600 level. So we were up 0.49% on above average volume. We are still negative in the short and intermediate term. The long term is looking a little vulnerable, but that long term support that I'll show you in a little while, it's holding for the time being. And we need to be able to stay above that and try to bounce up out of this for things to turn back more positive. But in the meantime, things are still looking more negative. As far as some comments, the tariffs that the US has now enacted on steel and aluminum, it's caused a real ripple effect, and it's leading Canada and the EU to announce retaliatory measures. So these are trade wars that are going on here, and it's kind of shifting back and forth depending on when you read the news because it's changing pretty quickly there. And for another day now, we saw this on Tuesday as well. Mega caps and growth did outperform. Now, on Tuesday, they outperformed in the sense that growth was up less or down less than value, where it was actually an outperformer in Wednesday's session. And we're still holding above that long-term support level. We're still quite a bit of ways above 20 with the VIX. We're at 24.23, but we are coming down, but we're still above that 20 level. And our short-term list is still pretty long. In fact, we have a couple of new additions here. The ADX, that's what we use to measure the condition of the trend in the short term. It's above 40 and doesn't necessarily mean it has to stop. It's just when we get above this level, that's when we start paying attention to it. And then the 20 period moving average on the S&P itself, that's getting extreme negative. And we're seeing again the rate of change going back 5 and 10 periods are extreme negative. And then we have the usual ones. When we're usually moving up or down, these indicators are extreme positive or negative. The Stochc RSI, Williams percent R, CCI 14 and 20 in stochastics. Even with the slight bounce that we saw, standard deviation, we're still in that -3 channel. And the momentum oscillators, they're starting to get pretty extreme currently. The slope oscillator, that's a short-term one, it's extreme negative. We're still far away from the 20 period moving average. And the short-term RSI, it's trying to work its way off a little bit, but it's still extreme. And now we're starting to get extreme negative with the 20 period moving average study. In the intermediate term, kind of a long list here. The rate of change going back 50 periods. And now we're seeing some of the PMO studies looking extreme negative, and we're far away from the 50 period moving average. The TTM squeeze is extreme negative and the Sean trend meter. We still have a non-confirmed Hindenburg Omen. We had the initial spike on March 3rd. We have until March 31st. That's calendar days. We have to count it out 20 trading days to get another spike before it's actually confirmed. And no change with the overall scenario. The Fed's leaving rates where they're at right now. The dollar was up, interest rates were up. We're at 4.32% with the 10-year yield, where we had been at 4.29%. We're still extreme negative with sentiment. We're below that 25 level. It's coming in at 20 right now, where it had been at 16. So it did bounce up, but we're still below 25. And we're not inverted any longer with the 10 to the 3 month. So this is just something that we're watching. Another day or so, this could easily go back to being inverted again. Or maybe it's going to bounce up and stay uninverted, if that's even a word. We're still negative with our trend. The ADX is above the moving average. It's above 20. It's going up. That's getting stronger. We're in a confirmed trending environment, and it's negative because the red line is above the green line. But we did have an update, so our bias is positive for right now. But the momentum is still negative overall. So we did get some economic reports. The big one will be CPI that I'll go through here in just a moment. Every week we get the MBA mortgage applications index. It was up 11.2%. Last week it was up 20.4%. Here's CPI, the headline number, less than expected, up 0.2%. They expected it to be up 0.3% and down from the 0.5% that we saw last time. Core CPI, this is the inflation component, came in less than expected, up 0.2%. They expected it to be up 0.3%. Last time it was up 0.4%. So this was taken more as market friendly. And then the Treasury budget came out, lot of an increase here with in the negative side here, a minus 307 billion. Last time it was minus 296 billion when you go back a year ago and look at this. Here are some charts. First, the mortgage applications, still positive, but down from the previous week. Year over year CPI actually starting to turn down. The blue line is the total, and then we have the yellow line, the core, and that's what the market likes. That inflation is still having a tendency to go down on a year over year basis. So we'll see if that can continue. And this is before all of the tariff ramifications may kick in, because that's one of the fears is that the tariffs are going to increase inflation. And it's going to take some time. This is all still Biden administration stuff that we're dealing with now for the most part. And then the services commodities, when you take out energy, that's the blue line, it's going down. The core commodities, though, are going up. And that's what we've been seeing in some of the charts. And I go through the intermarket analysis each weekend, and the CRB index is in an uptrend, and some of the commodities are going up, and that could be considered inflationary. And here's the federal budget, where this is going down, but it just means it's more negative than it was before. And then the receipts and outlays, where we're seeing a pickup here in the outlays. Surprise, surprise, a lot of spending going on there. And then the receipts, that's the blue line, that's what they're taking in. And this difference between the two, that's why we have a bond market. And that's why the government debt is getting so out of control. Now, here's CPI, just looking at the chart. This is a 12-month rate of change. So it's a year over year change where it is coming down here. And then we have a month over month change. This was causing some concerns going into the end of 2024 where it was going back up. Now we saw it fall down a little bit. Now we'll see if that can continue, or is this just kind of an outlier report? Core CPI as well, also going down on a year over year basis, coming down on a month over month basis as well. All right, then looking at the net bullish sentiment, coming in with a very low reading right now at 2.1. So yeah, this is not looking really good as far as sentiment is concerned. People are a little gun shy about the market right now. Now you can take this and do whatever you want with it. It says even years that gain 20% have a bad day. Well, okay, fine. But we don't know if we're going to gain 20% this year, and we've already had a number of bad days. But this is just trying to crunch some numbers that say and I teach this as well in my course, that when we're in a solid uptrend, that's probably when you'll see some of the biggest down days. And when we're in a downtrend, that's when you'll see some of the biggest up days. It just seems to work that way sometimes. It doesn't mean the whole thing is shifting over. We just see a real contrarian move going against the overall trend. Then the recent mutual fund and ETF flows, well, a lot of money going into money markets. It's leveling off with bonds and leveling off here with going into equities or stocks. And this seems to come up quite a bit. They're dealing more now with valuation of the market. And with the S&P anyway, we're still over that 20 level. We use a 10, 15, 20 scale when it comes to the PE ratio. When we're above 20, we're considered expensive. And then you can compare that with the rest of the world's valuation. Then annual U.S. payroll employment growth in the month before each post-war recession. Okay, and it just says here, annual job growth is hitting the economic stall speed. Only one other post-war recovery had job growth as slow as it is today without falling back into a recession. So this is one of the, uh-oh, things might be getting a little bit nervous as far as going into a recession type of a thing. Then economic policy uncertainty, and that's what's kind of causing some concern here now. With as far as the stock market is concerned, it's like when in doubt, sell. And we're seeing a real rise in uncertainty or certain uncertainty. How's that? And then market pricing about one cut by June and three later this year. Okay, lots of luck with that. There's really nothing on the horizon that's currently telling us that that's actually going to happen, and the Fed has not come out and said that. But the market still likes to think that there will be rate cuts, which may be because of an economic slowdown. Remember the context for why would the Fed come in and cut rates? They came in last fall and cut rates. The economy seemed to be doing well and we could still, do well with interest rates being lower. That's one context. If the Fed is coming in and cutting rates because of economic weakness, that's a different context. Then systematic strategies. This is when folks follow a system. They don't really try to time the market. They just say, okay, I'll put in my $100 a month or $1,000 every 2 weeks or whatever they do. It, it's not performing all that well, but nothing is really performing all that well right now since we've been going down. And below consensus US growth, it's actually falling below. We have the Goldman Sachs falling below the Bloomberg consensus as far as the growth forecast here. And then this is kind of interesting. The risk appetite, well, we start going down and people lose their appetite really fast. They're headed more towards risk aversion. And that's what we've been seeing is some folks have been pulling their money out of the stock market going into the bond market. That's seen as a flight to safety. And then where do you think the market will be 30 days from now? Most people think it will be down. Well, this could be used as a contrarian indicator, but we have other contrarian indicators that we've been following now for a while, and we've been camped at these contrarian levels where we should see some kind of a bounce. I mean, more significant than a 0.5% increase than like what we saw on Wednesday. It just hasn't really materialized. And then I won't go through this, but these are the different sectors that folks think will do well. One thing to notice, though, is healthcare. That's more defensive. And they think finally financials will come back. They've been under pressure lately as well. And staples, not as bullish on this as they were before, but still more bullish with a lot of the growth areas we're seeing money actually coming out of. And then the S&P versus tech, industrials, consumer discretionary, financials, healthcare, rolling 30-day rolling correlations of daily returns. Okay, I put the red box around here because obviously people other than me also make mistakes. This should be February 19th, 2025, right here. But when we get down to a really low level like that, that ends up being more negative for the market. And now that we're coming back up, that could end up being more positive. It means maybe we overdid things a little bit here. Then when we get really high readings, you can see here, this was the in the what I call the Christmas Eve mini meltdown. We were getting a high reading there. This was right before the COVID crash. This is when we were going down in 2022. Now, this is going up here, but it's still below this dashed line. So that could end up being positive for the market. And then corrections are usually good buying opportunity. Well, yeah, it's like buy the dip, but what does a dip mean? And timing is everything. I mean, you could end up being right about something, but if you time it wrong, you're going through a nightmare and if maybe having to actually take a loss. But when we have a correction following 21, what are the returns after 21 corrections of 10%? Because we have on an intraday basis gone down more than 10% from the February all-time high. 1 month out, not so good, but then it starts to get better when you look out 3 months, 6 months, and 12 months, and then whether we have a recession or not. Well, right now we don't. So we could focus right now on these blue areas. All right, here is the chart. We did gap higher right up at R1 here, but that set the high. We never got back to that level before. We drifted down below the daily pivot, below the unchanged level, found some support at 55.50. This is where we saw a nice little bounce here, but then we just kind of fizzled out. We tried to go lower, tried to come back up. No real conviction going into the close. So yeah, it was an up day, but was it just to work off some of these extreme negative readings, even though it didn't really do that? We did see some improvements internally that I'll go through, but we need to see more after this to get more confidence about things. And we're up a bit in the initial overnight session here. Before the market opened on Wednesday, we were seeing the futures quite strong, and then CPI came out and that gyrated things around a little bit. Saw some selling into that, bouncing back and then chopping going into the close. We're seeing a little of an improvement here, even though they're on different scales. We're seeing the blue line back above the red line. That means on an intraday basis, large cap growth is outperforming large cap value. And for 2 days now, we've seen this, the growth to value ratio for the S&P. It's been coming up. It's going to need to continue. I pointed this out last week. We saw a couple of good days here, and then we just fell off a cliff after that. So we want to see more of the bigger trend, like going back to the middle of February where we were doing pretty well, and we've been going down with a lot of conviction ever since then. We need to see this really go back up to turn more positive. So end of day growth was up 1.61%, where value was actually down almost 0.5%. It was up for the mid caps and down, but down less for the small caps. So a little bit of a bounce here, but still an awful lot of damage was done to the small cap growth to value ratio. Also to the mid cap growth to value ratio. Hasn't even come back up to its 200-day moving average with this ratio, and we're bouncing a little, but no real improvement here with S&P growth to value, looking at the ratio. And still below the rainbow with this growth to value ratio here. And we saw just a real drop in staples. But we also saw not a real advance, in fact, a bit of a drop here with discretionary. So yeah, the ratio did tick up a little bit, but it's not really showing much of an improvement. And here's the intermediate term trend here, where we're going up with the ADX above the moving average. That means a strengthening trend. We're above the blue line. That's a confirmed trend. The red line's actually coming down a little bit, but it's above the green line, so that's a negative trend. And we're also above 40 here with the short-term trend condition chart that I use the ADX to analyze. We're above the moving average. We're still going up here. The red line is above the green line. That's negative in the short term. Coming down a little bit, but still looking pretty solid with volume. And coming down a little bit here with this one sentiment gauge, the Ulcer Index, but it's still very high. Coming down as well with the VIX, but it's still giving us a reading above 20, both with the line chart and the bar chart. Coming down with the VIX of the VIX, that tends to fall when the VIX falls. Momentum for the VIX is still up as measured by the MACD. We're going up with this fear gauge. So even though some of our fear gauges came down, this fear gauge is still going up, and this other fear gauge is still going up. And we're still keeping an eye on the spread between risky, meaning junk bonds, and not as risky bonds, meaning government bonds. This is continuing to fall. That means fear is increasing here. And this is a concern to us, especially if it keeps falling. And it really didn't improve. in Wednesday's session. We went up a little bit here with the equity put call ratio. We're back to going up with the 5-day chart. And it's hard to see, but we were up 1/3 of a percent. We're barely going up again with the 10-day chart. We bounced a little bit here with the risk on to risk off ratio, but overall it has been really declining. And we're kind of right at the top end of the rainbow here with the volatility risk premium. So no real fears being picked up here. And the advanced decline line, seeing a little bit more weakness. Now the S&P was up, but we're seeing for a couple of days now, we've been seeing value taking a hit, and that's having more of an impact on the advanced decline line based on price. And we were pretty much flat based on volume. But longer term, as I always point out, we're still above this advancing moving average. And we're below the midpoint and going down here with our advancers minus decliners, seeing a little bit more weakness than what we've been seeing, especially with the S&P having an up day. And we saw virtually no new highs here and a contraction of the new lows, but still greater than any new highs. That's more negative. So we're going down with the 5-day chart and the 10-day moving average chart. We're below zero and declining with our advanced decline ratio. So see, there's not a lot of improvement that really happened. Little areas, but nothing all that major. We're still above the moving average though with accumulation distribution. We continue to go along sideways for right now, but we're negative here with the chicken money flow. The histogram went down and the red line's going down. We're going back down. We're right at the midpoint with the chicken oscillator. So two out of our three smart money indicators are negative. The other one's just hanging out above its moving average, but not really moving. The vortex, we're coming off of this green line here. That's buying. It's actually, I was pointing this out that we were extreme since we went below this line. It's coming back up a little bit. And the red line's coming down just a little bit, but it's still negative because the red line is above the green line. And we're seeing a little more weakness now with the advanced decline line for the S&P. We're looking more negative across the board here with the NYSE common stock. Now the S&P is below the moving average. We're already showing weakness with the mid caps and the small caps. Haven't shown this in a little while. This is the 10-day average of the S&P 500 highs minus the lows. We're dropping below 50. It had hung out. It had been declining, but it was hanging out above 50. Now we're starting to see this drop was a little bit longer term negative. And we're starting to get extreme with those stocks in the S&P above their 20-period moving averages. We're right down at 20. That means 20% of stocks only are above their 20-day period moving average. We could drop lower than that, and that's why we use this like an oscillator. We saw this really coming down in late 2024 and then a nice little bounce here, but we didn't see all that much happening with the index itself. And we're still declining and negative with the 50-period moving average study, almost getting extreme with the 100-period moving average study, and falling even further below the 200-period moving average study. And we're still below the 200-day moving average. At some point, if we stay here for a few days, I'll drop using this chart because it's just telling us what we already know by looking at other charts. And we're still hanging out below this blue line, which is an anchored moving average going back to the low set a year ago. We lost that, and we're still below that. What we're watching now, this is the low set back in 2023. If we continue to fall, this is a pretty significant level, and we'll have to see if that holds, but we're not there yet. We still have quite a ways to fall before we get there. And on a percentage basis, going to the all-time high in February to the low set in Tuesday session, we're down over 10% intraday. Maybe not on a closing basis, but intraday we are. And that's considered a correction. And we'll have to see. Going back to last summer, when we saw just about a 10% correction, we hit a low and then had some interesting days along the way here, but then we were able to break up out of that. We'll see if something like that can happen this time. And short term, again, we're below the 200-day moving average. We dropped off with volume, but we're still above average. And here's where we're starting to get extreme with the 20-period exponential moving average on the S&P itself. We're still declining with the 50 and the 200. And we're far away from the 20-period and 50-period moving averages. And we're below the midpoint with the 200 moving average study. Condition of the short-term trend still not looking good. We're still seeing a series of lower highs and well, not in Wednesday session, but for the most part, lower lows. And we're still extreme with the Stochk RSI, the Williams percent R, CCI 14 and 20. And we're still extreme with all of our stochastics in the short term, intermediate short term, and long short term. And bounced up a little bit, but still negative here with the force index. We're extreme with the rate of change going back 5 periods. The other time that this happened was back last summer, and then we were able to eventually bounce up out of that. We're just wondering if something like that can happen this time. Rate of change going back 10 periods also had an extreme reading, similar to what we're seeing now back in August, and we were able to bounce up out of that. So, and then 20 periods, this is also considered short term. And getting down here, now we saw another low reading here. So we're seeing a convergence of these things coming together that are still extreme negative that we were able to bounce up out of last time. We're wondering if we're going to be able to bounce up out of that this time. And we're still in the -3 channel with the standard deviations chart. Intermediate term, the balance of power is still extreme negative, or we're negative. We're close to being extreme negative. Negative with the go, no go with the purple bars. We're still dealing with the lowest low value. TTM squeeze, still extreme negative below this black line. Longer term, still getting very low readings here. So even on an intermediate term basis, the market is dealing with being oversold. And then the rate of change going back 50 periods, not a extreme reading right now, but coming down. Well, actually, we had this extreme reading back in October of 2023. And then last summer, we had a reading that was actually a little bit higher than what we're getting right now. So we're seeing a real convergence of these rate of change charts, both in the short and intermediate term. Still moving very fast according to standard deviation, going back over the last 10 periods. Bouncing up a little bit, but still quite negative with the ease of movement. Going down, we're seeing a little bit more weakness now with the McClellan oscillator for the S&P. If we drop below this line, that's when we start to get extreme negative. So we're still going down with the summation index based on price and volume. Ticked up a little bit with the NYSE McClellan oscillator, but still below zero. So we're still going down with the summation index based on price and volume. Still negative here with the Arun, below zero and declining with the oscillator. Going down with the Swollen Trading Oscillator based on price and been kind of chopping along here, but now going down with the Swollen Trading Oscillator based on volume. Momentum, quite negative right now. PMO's going down. We're going down based on price and volume. Starting to get extreme with the PMOs that are rising. We're dropping below this red line. That's where we're getting overextended to the downside. We're still declining with the buy signals, and we're continuing to go down with the PMOs above zero. And getting extreme negative here with the slope oscillator, a lower reading than what we've been seeing on this chart. Also getting a very low reading here with the MACD, but still negative until proven otherwise. So with the short term, we're getting pretty extreme with the slope and TSI. Starting to get extreme with the MACD, the PMO, and the PPO. Still negative overall with the TRIX and the KST, but you could make a case that these are starting to get extreme negative as well. And the Copic curve, negative, but possibly extreme negative, getting far away from where we've seen a bottom in the recent past. We've gone from negative to neutral with the Elder's Impulse system for the S&P. We're still negative with the parabolic SAR. Negative here, even though we ticked up with the money flow. We're well below 50. And ticked up a little bit with the Ultimate Oscillator, but also below 50. Ticked up, but still extreme negative with the Sean trend meter, below the moving average with unbalanced volume, and not really extreme here with the intermediate term RSI, but still extreme negative with the short term RSI. Condition of the intermediate term trend still looking really weak currently. And we're below all the moving averages here. And the more we stay below all these lines, the more they have a tendency to roll over and look ugly. And even though we had the up day, we're still going down with the bullish percent index for the S&P. We're declining with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. So other than the mega caps bouncing up a little bit, helping the index, It really wasn't that strong of a day. We're waiting to see if a mass index signal is going to be triggered. We need for this line to come back down to the red dash line, and that's trying to signal a reversal. We're also waiting for a buy signal here with the Pring bottom fisher, but we're not there yet. And then we're still above this 50% Fibonacci retracement level. That's been holding at least to this point. If we go up, is this 61.8% retracement level? Is that going to provide overhead resistance? And this is kind of the big one that I've been focused on lately. This is a weekly chart of the S&P with pivot points that last for the whole quarter. We're still right about at this pivot point or a little bit above it right now. This is pretty significant. Are we going to be able to bounce up off of that? If we fall down below it, then yeah, things are going to turn much more negative. All right, we are still negative with the trends when looking at the Heiken Ashi chart. The Kegi chart is negative since it's red, but now it's pointing up. But we're still going down with the Renko chart, and we're still negative with the three-line break chart. Long term, haven't had to show this for a long time. This is a long-term oscillator called the Special K, and it crossed over positive in late 2023, and it's been positive ever since. We're in danger of this thing crossing below the red line. That's going to turn things more negative longer term. And then looking at the 150 and 200 period moving averages, still seeing weakness there. No real changes here. We're negative in the short and intermediate term with the S&P, mid caps, small caps, and the triple Qs. Still positive in the intermediate term with bonds based on price as well as the short term. Negative with commodities in the short term. The dollar is still negative in the short and intermediate term. And we kind of down the middle here. We had tech, discretionary, and communication. They performed the best, and those are growth areas. But was this just some kind of a relief bounce after they've been getting hammered lately? We need to see more follow through from these three areas if the market's going to turn back more positive. And then some of the areas that are more defensive, like staples and healthcare, they got hit harder and all green. So the S&P got back above 5,600, and then we went above 50, 17.5, 17.6, 17.7. All this happened right at the open. And then the market just kind of floundered around for the most part after that. We're still below the 200-day moving average with the Dow. We're still negative with the diamonds looking at the Elder's Impulse system, and still above this S2 level with the NASDAQ. It was up over 1% and still above this S2 level with the NASDAQ 100. So these support levels are holding for right now. And we've gone from negative to neutral with the Qs when looking at the Elder's Impulse system, but the momentum for the NASDAQ 100 is still down. Small caps, kind of right at this pivot point right here, this S2 level. We're getting really close to seeing a death cross here with the small caps. And here, not looking all that great either with the Russell 2000 small caps, pretty negative across the board there. Still neutral with the Elder's Impulse system, though. For the small caps, not all that much strength. We were actually down a little bit with the mid caps, but they've switched over to neutral after being negative when looking at the Elder's Impulse system. Still below the 200-day moving average with the Wilshire 5000, even though it was up almost 0.5%. Still below the 200-day moving average with the total U.S. stock ETF. Financial sector, virtually unchanged, but it's really been coming down lately. And the FANG index came up and closed right at its 200-day moving average. These are the big stocks, and those are the ones that saw some favor in Wednesday's session. So it's not surprising that we came up and stopped right at the 200-day moving average. Apple was down 1.75%, dropping further below its 200-day moving average. Amazon was up 1.17%, coming back up to its 200-day moving average. Microsoft was up 0.75%, but is in a downtrend. Meta, right in between the 50 and 200-day moving averages, it was up 2.29%. Google still under its 200-day moving average, up 1.87%. Nvidia bouncing up a little bit, but we could be getting ready to see a death cross here with this. As long as these prices stay underneath both of these lines, then these lines are going to cross over negative. Tesla, which has just been getting hammered in more ways than one lately, it was up 7.59%. Is that just a technical bounce, or is something starting to happen that could be more positive? Netflix was up 2.75%, but still not back up to its 50-day moving average. And we're pretty much neutral now on a short-term basis when we look at US versus world stocks, and longer term, we're right down here at the midpoint, looking neutral. We were up with oil. We're getting back up into the high 60s again, and virtually unchanged right now with the dollar, but we're still seeing a real big downward move here after the dollar had been quite strong. And we're going back up here with the 10-year yield, but not up to that 4.5% level, at least yet. And we're coming down here with the 10-year based on price. Wanted to show this. We're still looking weak when we look at the ratio between home construction and 3 to 7 year bonds. This has not been looking good for quite some time now. We're just barely back to being uninverted or regular here with the yield curve when we look at the 10 to the 3 month yields. And a little bit of a tick up, but still negative overall with our growth to value ratios, Qs to S&P, discretionary to S&P, large cap growth to large cap value. A little bit of a tick up with the large caps, mid caps, and small caps, but still below declining moving averages. So what's our outlook for Thursday? No real changes here. Just it seemed like a little bit of a relief bounce, and the mega caps just kind of helped things out. We're still negative in the short and intermediate term. We're below the 200-day simple moving average, and we're still testing that very long-term pivot point, which is long-term support. We're going to get the M. Okay, I didn't update this. We'll have to go look at the next chart here. We're going to get jobless claims and PPI coming out. Not as important as CPI, but you never know. There's been some times when the market really reacted to PPI coming out, and then we'll get consumer sentiment on Friday. Here's a look at the calendar. And as far as seasonality, neutral to positive with the Dow, and we're flat out positive with the S&P and NASDAQ for March 13th. And looking pretty good. Whether you look at all the days together, those are the solid lines, or in a post-election year, we tend to see some positive seasonality on this day. So we'll see if that actually falls through to reality. And we're still dealing with the first half of March, which is supposed to be doing well, but just has not transpired as of yet. Also, March tends to do okay and then tend to see better April and May's after we got done with February, and we can see a lot of choppiness going on right here before things could potentially turn better. All right, so our smart money indicators, they're still mixed. We're above the moving average with accumulation distribution, but we're declining with the Chaikin money flow and the Chaikin oscillator. We're going up with our 5 and 10-day equity put call ratios, and we're going down with the S&P and NYC McClellan oscillators, which are making the summation indexes decline. Parabolic SAR is negative. The bullish percent indexes that we follow are negative. Momentum is negative. The Swindler trading oscillator is negative. We're getting extreme negative with the moving average studies based on 20 periods. Ease of movement, money flow, and ultimate oscillator are all negative. The vortex is negative, and the momentum for the NASDAQ 100 is still negative. On the positive side, the longer term trends of growth to value are still positive, but in the short term, they've just been getting hammered and didn't see much of an improvement on Wednesday. Financial sector is still in an uptrend, but it's been seeing some recent weakness, and we're under the 200-day simple moving average still with the bank ETF. Just want to keep an eye on that one there. So our conclusion, we're negative in the short and intermediate term. We're kind of positive in the long term, but we're below the 200 period simple moving average. We're still negative and oversold in both the short and intermediate term. We're still somewhat positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.